Overall and dedicated reinsurance capital grew again in 2024 and is projected to grow further in 2025. I'm John Weber for AM Best TV, here to discuss a new report on the subject, part of AM Best's overall look at the global reinsurance industry ahead of the Rendezvous des Septembre in Monte Carlo is Associate Director Antonietta Iachetta. Antonietta, as always, great to see you.
Hi, John.
So, Antonietta, the annual increase in the traditional and third-party capital areas are similar in size, but are there different forces driving each segment's growth?
Absolutely. While the headline numbers might look similar, the drivers behind traditional and third-party capital growth are quite different. Traditional capital is largely being fueled by strong underwriting results and a benefit of higher interest rates, which have significantly improved insurance return profiles. We're also seeing continued pricing discipline across many lines, which makes the sector more attractive for shareholders and internal capital deployment. Third-party capital, on the other hand, is being driven more by investors' behavior, particularly the demand for uncorrelated returns. Institutional investors like pension funds continue to show interest in insurance-linked securities and similar instruments, especially as the access and transparency in this space has significantly improved. But it's also worth noting that reinsurance themselves are using the structures more strategically as part of their capital stack. So while both are growing, they're responding to different sets of incentives. One more grounded in insurance market fundamentals, and the other in broader financial market dynamics.
So do you expect this momentum to continue in 2025, Antonietta? And what are some of the things that you're thinking about that could disrupt your expectations?
At this point, we do expect the momentum to carry through in 2025. The structural demand for risk transfer is still growing, whether from climate volatility, geopolitical tensions, or the continued emergence of risks like cyber. And capital providers, both traditional and alternative, remain interested in the space. That said, a few things could shift the outlook. A major cat event, or a series of them for that matter, could tighten capacity, especially on the ILS side. But also economic factors could matter, right? If we see a sharp slowdown or market instability, investor appetite for liquid or volatile assets could wane. So while we're optimistic, we're watching all of these factors very closely.
Now, in previous years, you've noted capital largely remaining on the sidelines despite the growth. Are we still seeing that?
Yes, to a degree, that's still the case. There is definitely more capital, but not all of it's being deployed at scale. We're seeing a much more selective approach, both from traditional carriers who are prioritizing margin over growth, and from third-party investors who are more focused on structured, targeted opportunities. Some are still hesitant given some of the recent volatility, concerns about secondary perils, climate-related risk, and also loss development and loss costs in prior years. So while the capital is available, it's not necessarily flowing freely across all lines or geographies. It's being deployed where the risk-return profile is very clearly aligned, and that's a sign of a more disciplined, sophisticated market.
Antonietta, thank you so much for taking the time to speak with us today.
Thank you, John.
That was Associate Director Antonietta Iachetta. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.